Hi, good evening, everyone. Now, can you all hear me? Can you see my slides? If you can hear me, you can see my slides. Can you please type in the chat box or just give me a thumbs up? There's an emoticon. You can just give me a thumbs up. I can see that you all can hear me. Okay, very good. So we do some warm up before we are going to start with today's session. Now, this series is what we call as Let's Learn Futures webinar series. This series is brought to you by Bursa Malaysia and managed by our company, Excellent. My name is Ting Ting. I'm the moderator for today's session. Our topic for today is enhancing your portfolio return using FKLI and FCPO. So technically, you need to understand why in your own portfolio, you must have these two products. FKLI and FCPO. So later CY is going to explain to you. Now, before I start, please make sure that you can hear us, you can see our slides, then you are good to go. Now, please turn off your video just in case nowadays our internet connection is very weak as well. In Malaysia itself, it's really very weak, and some of the areas you can't even connect to the internet. So please just turn off your video to make sure that you can listen carefully. Now, along the way, for today's session, we are going to separate it into two different sections. So the first section consists of 60 minutes. It will be presented by our speaker for today, CY Saw. And the second session will be 30 minutes. It will be a Q&A session. Along his presentation, if you have any question, anytime, you just need to click on the Q&A box and just submit your question. I just repeat, please click on the Q&A box and submit your question accordingly. We will answer all your questions at the end of the day. Now, please do not submit any question via chat box. The reason behind is through the chat box itself, we might not be able to read out your question. So I repeat, please remember to submit your question via your Q&A box and just select all co-hosts. If not, we are not able to pick up your question. Now, beside today's session, upcoming, there's a whole series of webinar series. We are going to conduct this in 3 different languages, English, Malay, and Mandarin. You can search for the session that you would like to attend, and you can just register accordingly. For example, next Tuesday, we are going to have this kaedah price action untuk mencapai ketepatan analisa yang lebih tinggi. So if you are interested, you can just scan this QR code and just register accordingly. Now, if you are going to attend for the upcoming English session, the next session, it will be a bit advanced topic for intermarket quantitative modeling for FCPO and FKLI trading. So you can just take a photo and send it to your friends and share it to your friends, and you can also register by yourself. Now, beside this webinar series, Bursa Malaysia also organized a series of online workshops. Now, unlike webinar series, this online workshop, we are going to guide you through from A until Z, until you can submit your first futures contract. So this is only for serious learner, meaning that if you're really interested to kickstart in your futures trading, then only you register. Please don't take up other people's space because the registration is limited, the seat is limited. Now, upcoming, we have 2 sessions. One is for Mandarin session, another one is for English session. You can select the session to register accordingly. So we separated into 2 different workshops from 9:30 to 12:30, and afternoon sessions from 2 to 5 p.m. So we are going to hand-holding you from A until Z, and also we incorporate this training simulation for your better understanding. Now, each online workshop is only limited to first 50 online attendees. Every session we open up to 150 for you to register, but on the day itself, only 50 online attendees will be accepted. Now, just for information, if you are going to register for 20th of November, the class is near to full. So if you're really serious to kickstart your futures trading, please register as soon as possible, because once the class is full, we are going to close the class. So you can scan this QR code, or later we are going to send the link in the chat box. You can click on the link to register accordingly as well. So I give you 5 seconds. You can take a photo and you can share it with your friends, or you can register by yourself. 1, 2, 3, 4, 5. So thumbs up. We're going to start with today's session. Before we start with today's topic, I'm going to introduce our speaker for today. Our speaker for today is CY Saw Chun Yen, well known as CY. So he's the chartered market technician, chartered holder, and he has vast trading experience in local and international stocks and futures market. He's also a certified master trainer of NLP and ISN, and he's also a performance coach with extensive experience in coaching individuals. His specialty is in trading system and strategies, trading psychologies, and NLP. So without further ado, please allow me to pass it over to you, CY.
Okay, thank you, Ting Ting. Thank you very much. Let me put my slides up here first. All right, I have shared my slide out. Can all of you see my slide? If you can see my slide, please type in a yes in the chat box so that I can know that you are able to see it clearly from your side.
CY, I can see it as well. Good to go.
Okay. Hi everyone. Good evening. How are you doing? So I believe that everyone is actually doing well right now, especially these 2 weeks is quite pretty good news where COVID cases are getting lower and lower throughout our nationwide. So today's topic is about how you can use Malaysia futures product, which is FKLI and FCPO, to enhance your portfolio return. So it may be an advanced topic for you because it deals with your overall portfolio. So whenever, when we want to speak about portfolio topic, right, most people do not want to listen to it because they are not interested in portfolio. So given the fact that you are here today listening to this webinar right now means that you're actually someone who is actually a serious investor and a serious trader who are actually really concerned about your total, your general portfolio. Okay, so majority of the investors and traders in Malaysia, they only know about the stock market only, and they know about stock investing, stock trading. That's fine. And a very small amount of portion actually knows about futures trading, that we can actually trade futures in Malaysia. And majority of them who knows about future, they trade FKLI only, because they can relate this very well towards the stock market easily. However, when it comes to FCPO market, I believe many of you here are quite familiar with this futures product, but you are quite unsure and do not know why you are actually able to add this futures product into your portfolio, that it can actually gives you a good diversification as well as enhancing your portfolio return. So there are a lot of things where stock market cannot do that, futures product can actually cover all these benefits for you. So today I'm going to address this question. And by the end of this session, you will understand several core concepts of why and how you can diversify your portfolio to enhance your total portfolio return, because in the stock market there are limitations in diversification. So when you are able to actually add another one special product into your portfolio, you can actually bring down your total portfolio risk as well as your portfolio volatility even way lower. Okay, and towards the final topic, I'm going to share with you some practical trading ideas that you may not heard of before. All right, so let's get started. Now, a standard and quick disclaimer where this is, of course, for educational purposes only, to give you a quick understanding and knowledge about trading futures, FKLI and FCPO. And of course, in this session, because I am going to share with you some trading ideas so that it can actually widen your horizon, your exposure, as well as your knowledge about trading. So these are only just examples. It does not amount to any investment recommendations or any trading advice. You still need to study more in-depth and more detailed and develop the necessary trading strategies that suits you. Okay. So today I'm going to give you some of brief trading ideas. So at the end of this session, you can think about it. whether you would want to, test out this idea so that this would actually gives your portfolio a lot of benefit. Now, I believe Ting Ting have already introduced me. My name is CY. Now, before I go into the topic, now I would like to know about, about you, whether you trade futures product or not. So how many of you actually trade FKLI? You can type in FKLI in the chat box. And if you do trade FCPO, you can type in FCPO in the chat box. And if you trade both FKLI and FCPO, you can type in both. I just want to see about, what is your level of interest about, trading? Because when it comes to trading, a lot of people, they just geared towards to, whichever product can make money, they just jump into it. So later on, I will explain to you why if if you just want to put your money in Malaysia only. So Bursa Malaysia, other than stocks, you can actually just add this, FKLI and FCPO alone. You can actually create a very, very good diversification in it. So here I can see your response that some of you trade FKLI, some FCPO, mostly actually FCPO. So I believe most new comers in the in the futures market, they actually trade FKLI because it relates to their experience directly towards the stock market. It's easier to understand. However, when it comes to FCPO, they are quite foreign with this product. And then later on, I'm going to clear some of the misconception about FCPO product for you as well. Now, of course, this webinar will be organized in 4 topics. So topic number 1, I'm going to explain the primary difference between stocks and futures. So it is very important for me to give you a quick revision, and because I believe many of you already know the differences between stocks and futures at the surface level. However, I am going to cover a little bit more in depth so that you can understand it at a deeper level. So while for some of our participants here, if you're still very new to futures, don't worry. I'm going to share with you, speak in a simple language as possible, right? So that you can understand it clearly as well. And the second topic that I am going to share with you is the primary differences between FKLI and FCPO. This is very important for you to understand because many retail traders, they get confused with these products. You might be thinking that, although both are called futures product, right? Yes, of course, they are futures product. But do you know that both are actually very, very different in the nature? Because different products have a different price movement behavior. So you need to understand how to customize trading strategies that actually suits them. And the third topic that I'm going to share with you is the fundamental concept of diversification. I notice a lot of retail traders, they understand the concept of diversification incorrectly. So if your understanding of diversification is incorrect, so when you apply into it, you may not get the diversification benefits. So in this topic, I will still need to share with you the concept again so that you can have a clearer and better understanding of diversification. And lastly, last topic, I'm going to share with you some of the basic portfolio management strategy in how you can create diversification using FKLI and FCPO. So here I'm going to share with you some trading ideas that you may have not heard of before. So we are going to apply what we have learned in topic 1 and to topic 3, how to use a futures product to create a diversification and enhance your portfolio return. So are you ready? Now, first, let me show you this picture. What can you see in this very picture? So you can type in your answer into the chat box. What do you actually see in this image from this picture? What can you see in this picture? Just type whatever that comes into your mind that you see immediately from this picture. So I give you 30 seconds to type in what you see. It's an interesting question. Although it is a very, very simple question, it is actually a simple question that can actually detect one of your psychology traits. How do you actually process information? So I see some of your questions are quite interesting. Some of you say tree. Some of you say very specific, pine tree. Some of you put forest. Another one would be even more interesting, would put your answer is money, foggy forest. Some of you put palm oil. I'm not quite sure whether do I see palm oil from here or not. So in fact, depending on what answer you put in this in the chat box. So if your answer is tree only, you're actually generally looking at a small picture. Or if you're just looking at pine tree, you're actually generally looking at a small picture. But if your answer is actually a forest, or your answer is multiple answers, you actually generally is you are considered as a big picture person, where you see the whole picture. You don't miss the tree. You see the whole general big view. So you might be wondering, why do I actually show you this picture here? You see, a majority of the traders and investors, they are quite short-sighted. They focus on the trees only. So they focus on the individual stocks that they trade. So they look at the small pictures only. And they don't look at the bigger picture, and they've totally forgotten about the forest, which is their whole portfolio. So here today, you are going to learn some of how you are able to diversify your whole portfolio. Because most people, they focus on the individual trees only, and they overlook the general portfolio. So it is important when it comes to trading, because you want to build your wealth, right? So we want to look at the total portfolio, the whole business of trading, rather than looking our individual trades or whatever individual things that we trade. Okay, so let's get started with the topic number one. What are the primary differences between stocks and futures? So some of the differences, you already know it, whereas for some of the differences, I am going to cover a little bit more in depth, so that you can understand how you can use futures product to your benefit as a Malaysia investor and trader. Now, before I share with you the differences, now allow me to share with you, ask you about what is diversification first. Now, let's pretend that you want to open a business. You want to open a fruit stall business. Which of these three ways would you do your business? Answer number one is that you would only sell one type of apple, regardless of what color of apple, maybe red apple or green apple. You just want only sell one type of apple. The second way of setting up a fruit store is that you also sell apple, but this time you sell a variety of apples. You may have red apples, green apples, or even yellow apples, apples from different countries. And lastly, you can also set up a store where you have a variety of fruits. You don't just only sell apples, you have oranges, bananas, and some other fruits. So let me know, type into the chat box below, which of these way would you actually set up your fruit store? Which way that you would want to set up your business? So if you understand this business concept, then it would be actually very, very helpful for you to actually, manage your overall portfolio, because it is important that, once you understand the business of trading, it would be easier for you to actually manage your overall wealth. So I see most of your answer, in fact, majority of your answer is actually C. So I believe most of you would choose C, right? Because you have a variety of fruits, and you understand that, people don't just only eat one fruit, right? People don't just only eat apples. Because different fruits have different nutritional values that they are rich in. And that's where you are able to diversify your investment. But the question is, do you know why you choose the answer C or not? Think about it. Why do you choose C? Now, most people, they do diversification, right? They just do it blindly. They monkey see, monkey do. People do like this. They will just also follow exactly the same way. They think that owning more stocks or trading more products in all different industries means it is considered as well diversified. And in the end, the whole portfolio might be underperforming. So this same concept applies to investing and trading as well. You don't just put all of your money into just stocks or a particular industry, right? And what happens is, let's say when the bear market comes in, or when there is a market crash, majority of the stocks will sink or go underwater, right? And you may get stuck in it. So that's the reason why you need to spread out your risk across different asset class. so that during bad times, your money won't get stuck in the stock market. So for now, remember this fruit stock example of diversification. So C is generally the preferred way of diversification. So later on, when I come to topic number 3, I will explain diversification in greater detail. Now, let's come back to the primary difference between stocks and futures. Some of the answer, you already know it, but some of it I want to cover into a greater depth. So generally in Malaysia, we have the stock market as well as the futures market. So in the futures market, we have a popular FKLI, FM70, as well as the FCPO market. So let's look at the differences. So in stocks, you can only, of course, trade one direction only, and you only are able to profit during up markets. Down markets, you are unable to profit from stocks unless you do short selling. For futures, you can trade both directions. You can profit from up markets as well as down markets. Now, when it comes to shorting the market, right? If you are doing in the stock market, of course, we can do intraday short selling, right? But it is only limited to intraday only. And if you want to do short selling in stocks, you need to borrow stocks first before you're able to short. And not all stocks can, in fact, short in Malaysia, right? So for futures, it will be easier for you to trade, up and down markets, right? Because there is a very, very high liquidity in there. Now, the second difference is on margin. Both stocks and futures have this thing called margin, but they are actually referring to the very, very different thing. Now, let's look at for stocks first. In the stock market, we have margin, yes, which is where we use in the terms of a margin account. So if you want to have a leverage in stocks, so it's either you trade stocks options or warrant, right? Or you use margin account to trade stocks, where you get the margin facilities from a stockbroker by borrowing money from a stockbroker to trade. So that's where you will be having a leverage. So you need a margin account and use these borrowing facilities to trade your stocks. So this is where you are borrowing money from the stockbroker to trade, and you need to pay interest charges on your borrowing. However, for futures market, this margin will be slightly different. For futures, the product itself is already considered as a leverage product. So all you need is just to have an initial margin. And this initial margin, in simple words, is called the deposit for you to open a position. You just need to pay a minimal deposit amount to open a futures trading position. So this type of leverage is actually interest free. You don't have to pay any interest at all to get leverage from the market. So it is actually very, very unique compared to the stock market. Now, the third difference is stocks, they trade almost forever. So as long as the company is still operating business, as long as the company is still meeting the listing requirements and listed in the stock exchange, it trades almost forever. Unless the company is having a privatization, then you are unable to trade it, right? However, in the futures, this you need to listen carefully. Majority of the people who started to trade futures, right, because they are coming from the stock market or the stock trading background, so they think that futures market is exactly the same as stock market, right? So they buy and hold their futures contract almost forever. So this is where it's a very, very big mistake. They think that futures market is exactly the same as the stock market. So in fact, it's actually very wrong. In fact, in futures market, there are many contracts for you to choose from. I believe you understand this very well. So if you do not know which contract to choose from, you can just, in fact, simply choose the highest trading volume futures contract. And the challenge for futures contract is that because it is based on the contract terms, it has an expiry date. So this is where you need to be able to know how to roll over your futures contract to continue your position. So if you do not know what is rollover or do not know how to roll over, please sign up to the LLF online workshop to learn more about this. I'm not going to cover how to roll over this topic today. And last point, which is very important, listen carefully. Now in stocks, in Bursa, there are 1,000 or over stocks for you to choose from, right? From different industries to different sectors. So stock picking skill is necessary, is important there. And also you need to look at many fundamental factors, including whether the company is well managed, about the company's earnings, the future's growth, and many other fundamental factors to look at. So this is on the stock market. It is very time consuming for you to do so. Whereas for the futures market, it is actually very simple. We have three products only. So we have index futures, which is the FKLI and FM70, where you just need to know the general market direction only. Where is Malaysia's company economy heading towards to? And the next futures product is actually the commodity futures, which is the FCPO, crude palm oil futures. So this is actually based on the real demand and supply. So you don't have to worry about which plantation that you need to invest in, or whether the FCPO is well managed, or whether FCPO has earnings or not. So later on, I'm going to share with you why commodity futures is actually very, very unique in these terms. Now, here we can see the first three differences. The top three are actually the structure of the product itself. You can't change it, right? And what you can change is actually you can change the last thing. You can control and manage this whole section, because in the stock market, you can manage which industry or which sectors that you want to go in, which sectors that you totally do not want to touch at all, or as well as where you are going to allocate your money into. And where are you going to add into your portfolio for investing and trading? So here we can see that in Malaysia, not only you can have trading or investing in stocks, you can actually add futures into your portfolio as well. So later on, by the end of this session, you will understand why adding a futures product into your stock portfolio can actually give you a very greater diversification. Now, let's move on to the second topic, which is the primary differences between FKLI and FCPO. So pay attention to this. Many of the retail investors and traders, they don't know the differences between FKLI and FCPO. So they think that, they can trade FKLI just like how they trade stocks. They can trade FCPO just like they trade stocks. In fact, they are actually very, very different. So once you understand the differences between FKLI and FCPO, you will know whether is it worthwhile to add into your investment or your trading portfolio. All right. And of course, I believe majority of the people out there, they are actually trading stocks as well as FKLI. So later on, you will see which product that you add into your portfolio would give you a greater benefits. Now, let's take a back this fruit stall example as an analogy again. You can see here that all are actually fruits, right? All of them falls under the same category, right? However, if we look closely into it, not all fruits are actually produced from the same country. So for example, in Malaysia, we are unable to produce apple, we are unable to produce kiwi, right? So even if Malaysia can produce apple and kiwi, it may not be as good as, a kiwi or apple from Australia or Japan. Now, in fact, although FKLI and FCPO considered as the same futures product, is considered as derivative products or futures products, right? They are considered the same category, but they are actually considered as a different asset class. So later on, I'm going to share with you what is the asset class in different terms. So here, let's look at the differences between FKLI and FCPO. So here on the left hand side is the FKLI and the right hand side is on the FCPO. So FKLI is considered as the index futures and FCPO is considered as the commodity futures. So where does FKLI, the value derives comes from? So FKLI, the value, whether FKLI goes up or whether FKLI goes down, it depends on the expectation of the company's futures earnings, right? The value actually derives from the top 30 market capitalization stocks in Malaysia. Whereas for the FCPO, it is slightly different. You do not need to depend on the earnings or whether the company is well managed or not, because the value from the commodities future is actually derived from the real demand as well as the real supply. There is a really physical exchange in that terms. And For index futures, the FKLI, although it is, you can see that because it is derived from the top 30 stocks, right, that represents the Malaysia economy. So this is actually similar to the category of stocks. However, for index futures, it is slightly different from stocks because it is actually derived from the top 30 market cap stocks, but they don't have any stock-specific risk. So stock-specific risk means that there is no risk on the company, there is no risk from the earnings, you don't have to look at the company management at all. And you also don't have the industry risk because for index futures, for FKLI, it already consists of a lot of different industries from banking, financial services, consumer products, tech stocks, healthcare, industrial products, all of it. So it is already well diversified. So if you were to trade FKLI, you don't have to worry about whether if your stocks is actually having a good management or not, whether the company management is well managed or not, whether the company has a good earnings or not. So there is no industry risk at all. All you need to concern about FKLI is actually the market sentiment, the market risk. Whereas for FCPO, this category is actually separate. It is not the same as the stock market. It has no earnings, it has no management. All you need to do is to look at the real physical supply and demand. So this is why for FCPO, it is considered as the commodities category. It is a separate asset class. So now, there is one question that I would like to ask you. If let's say, FKLI goes up, whether does the general Malaysia stocks would go up or go down? Type in your answer in the chat box. If FKLI goes up, whether do the general stock market in Malaysia or the general stocks goes up or goes down? Let me know your answer, whether it is going up or going down, or you do not know whether it's actually going up or not. So I see a majority is all same answer, up. So here we can see that if FKLI goes up, the general stock market is expected to go up, right? So here we can see that there is a high correlation towards the stock market. A high correlation here means that there is a very high relationship with the stock market. The relationship is very, very close. So if generally speaking, if FKLI goes up by, let's say, 200-300 points, the general stock market in Malaysia would follow the index as well. However, whereas for FCPO, because it is a commodity asset class, so whether does your stock market goes up, whether does your FKLI goes up, it has nothing to do with that at all. So here it has a very, very low correlation to the stock market, because you see whether whether there's a COVID or no COVID, you will still need cooking oil, right? You still need cooking oil to cook. You will still need palm oil ingredients product to do your biscuit, to do your Maggi, to produce Milo as your raw materials. So this is what is special thing about commodity futures. Commodities are actually all of those raw materials that we need to consume as a human, whether it is consume it internally, such as foods, or we consume it externally, like building materials, so forth and so on. Now, I believe that you have already understand the differences between FKLI index futures as well as the FCPO commodity futures. Now, I want to share with you one extra important information here. It is very important. Now, this additional information for you is actually very useful for you to better understand the FCPO market. So this is very important. Don't get confused with the FCPO, the crude palm oil futures, with the plantation companies. A lot of people think that FCPO goes up, plantation company has to go up as well. It is a very, very incorrect concept, because your understanding about these two things are incorrect already. In fact, FCPO and plantation companies, they are actually not the same, because as I've mentioned earlier already, FCPO is considered as commodity asset class, right? And plantation companies, what are you actually putting your money into, invest or trade? You're actually trading stocks. So we can see that there are really, really differences differences between stocks as well as a commodity futures. They are both different asset class. Okay, remember this. Now, let me give you a deeper look into what is commodity in. If let's say if you want to invest in commodity. So as I've already shared with you that commodity is considered as a separate asset class, right? And it has a very low correlation with the stock market. So generally, there are two ways that you can invest in commodities. So the first way is indirectly, and the second way is you can directly invest in commodities. So how you can indirectly invest in commodities is you can invest through stocks, commodity stocks. Okay, so these stocks is still based on your share certificates. So in Malaysia, of course, you can invest in plantation related companies. And do you know what do they do as a plantation company or not? Now think about it clearly. Just give a thought about it. Do you know what does plantation company actually do in their business? Most people would think that plantation company, they just have plantation land and then got palm trees, and then that's where they sell the palm oil, right? So in fact, it is not true. Plantation companies, they have a different, when it comes to specific, there are different segments in plantation businesses. We have plantation, we have milling, we have refinery as well. Plantation is where they have land bank, and that's where they plant their oil palm trees, and that's where they are able to harvest their palm oil to further transfer it over to the milling business. So the milling business is where you crush all of those palm oils into crude palm oil. It's like you get your apple and then you get your apple juice first, your crude apple juice. So this is on the milling business. And after you get your crude palm oil from the milling business, so this is where they transfer this product over to or sell it to the refinery or other oleochemical companies. So they are the party who would be buying crude palm oils to further refine the crude palm oil into a refined palm oil products like margarine, cooking oil, or other oleochemical products. So here in Bursa, Malaysia, under plantation category itself, we have 43 plantation companies. Okay, some are palm oil related. Some palm oil related companies, they fall under industrial product and services category because they are actually refinery business. So here you can see the stock selection in just searching the best palm oil companies is actually really not easy. There are so many companies for you to search on, right? So there are many plantation companies for you to choose from, and different plantation companies have different focus in the plantation business, from plantation, from milling, from refinery. And some of them has a lot of plantation business, but they don't have, their milling business is actually very small. Okay, so which is why you can see that when FCPO goes up, they don't really benefit from the FCPO price. Whereas for some plantation companies, they actually benefit very well, especially when FCPO goes up a lot. So here you can see that a lot of people, they get confused with FCPO as well as the plantation companies. They think that FCPO goes up means that all plantation companies has to perform well, as all plantation companies have to perform well. In fact, it's not true. We have to see what is the core business for the plantation companies, which segment they rely their main revenue from. Okay, so here, of course, for indirect investing of commodities is where you invest in stocks. So the price of your stocks goes up only based on the expectation in your company growth or from your increase in earnings. And of course, you need to look at whether the company is well managed or not. And the next thing on investing in commodities directly, which is on the commodity product itself. So of course, here, as we are speaking on trading products, right? Of course, you are not actually investing in plantation land, right? So what you can be doing in investing directly in commodities is actually you can actually add the crude palm oil products into your portfolio. So here in Malaysia, we have fantastic strategic advantage is that we are the second largest crude palm oil producer in the world after Indonesia. So this is where, our trading time is, we are actually following a Malaysian time. So we don't have to, rely on other countries that has a different time zone. Now, when we want to invest or trade the futures crude palm oil, there are several things that you need to take care of. So price goes up is actually based on the expectation of increase in demand or decreasing in supply, or both. So here you can see that the price drivers, what are the things that drive the price goes up or goes down? It has nothing to do with earnings. It has nothing to do with management. It has nothing to do with whether there is a growth in the plantation or not. It is purely based on the supply and demand of the crude palm oil itself. Okay, so remember, you can trade both up and down in the FCPO markets because you're actually trading the futures product. You can trade up and both up markets as well as on downtrends. And this is where you can also have a leverage, which is very, very what we call the interest-free leverage. You don't have to pay interest by having this leverage benefit from crude palm oil. Now, you must be wondering, why do I say crude palm oil is something good that you can add into your portfolio, right? So now let's go into the third topic, which is on the diversification. So as I mentioned earlier, many retail traders, they know about diversification, but they understand it incorrectly. So this is when it comes to the application, right, when they apply it, they may not get the diversification benefits. So please listen to this with full attention. Now, before we go into diversification, first we need to understand what is a portfolio. Let me explain this in simple terms. Now, initially, as you take up some of your excess money for investing or trading, right? So this is where you get, you put your money into your trading account. So this is where your basket is actually full of cash. You don't have anything. Your basket or portfolio is actually all cash. Then the next thing you're going to do is actually to buy something, right? Whether is it stocks or having some positions. So let's say you buy something and you convert all of those cash into stocks. So this is where it is very important what you put into your basket, because you are going to sell it out again, right? It's either you buy high and then sell it out higher, or you buy low or sell it out higher. So this is very important, because after you get these new products into your basket, you need to convert it back into cash. So ultimately, you want to make sure that your basket of cash is actually growing bigger and bigger. Can follow? Pretty easy, pretty easy, right? Now, next thing, let's go back on this fruit store example. So there are generally three ways you can set up your fruit store. So first one is where you sell only one type of apple. So this is where you just only sell all one type apple or only red apple. So this is where, like, you use your money to buy only one stock, one type of stock only, and there is no diversification at all. This is super concentrated. And the next way where you set up your store is where you buy all different types of apples and you expect to sell it. Now for this, you do something different. You actually use all of your money to buy different stocks, but all of these stocks are actually coming from the same industry and the same sector. So although you can see that, you sell different types of apple, you have Fuji apple, you have Australian apple, you have US apple, but all of it are still considered as still apple, right? So although they may have some form of diversification, but your overall portfolio, it is still considered as concentrated in one industry. Okay, make sense? And the third way of diversification, of course, is you don't just only sell a variety of apples. You buy different types of fruits like orange, bananas, watermelons, and others. So of course, this is a better way of diversification. Now, the next question is, why is it a better way of diversification? Think of this for a moment. As a fruit stall business, okay, think yourself as a fruit stall business owner, all right? Are the sales performance for every fruit the same every month? I repeat my question again. As a fruit stall business owner, are the sales performance for every single fruit that you're selling have the same performance every month. So which means, let's say now it's already October, you have a very high sales for apples. Does November and December and some other months have a high sales for apples or not? Let me know your answer, whether is it yes or whether is it no. If you think that you can have consecutively high sales every month for only one product, you type in yes. If there is no, just type in no as well. So I can see some of your answer here is actually no. Some of you are very, very specific, different shelf life and prices. That would be a better explanation. That's right. That's good. Wonderful. So here we can see that there are a lot of factors that affects why people buy different fruits, right? Because of, you may say, consumer preference, seasonal factors, because different seasons people eat different fruits, right? And different fruits have a different nutritional content and so on. So let's take durian, for example. In a specific month or a specific season, durian sales performance is superbly selling very well. But for some other seasons, durian just perform very poorly on any other normal seasons. You don't eat durian for all seasons, right? And for example, if you would want to, let's say you want a high fiber fruits, which of these fruit would you go for? If you want a high fiber fruit, which of these fruit would you actually go for? You may go for, you say, if you want high fiber, you may go for banana, right? How about if you want to have a high vitamin C fruit, which of these fruit would you go for? Very simple, you may go for, citrus fruit, oranges, or even lemons. So this is where we can see that different fruits has a different benefits, and not all fruits has all of those nutrients in one fruit. There is no one size that actually fits all. So the same thing when it comes to trading and investing. In your portfolio, not everything that you buy or have position in have the same performance every single month or every single year. Okay, I repeat, not everything that you buy or have position in your portfolio have the same performance all the time, every single month, every single year. No, it's like the example is the same like how you would be operating a food store business. Okay, so especially when we want to look at the downside and risk, diversification is mainly we would want to look at the downside and risk. So most of the time, when the general market, let's say when the general stock market performs negatively, and you do not want your whole portfolio to perform badly, right? So this is where you are only able to see diversification benefits, right? And this is where diversification is very, very handy and important. When the market is performing very well, when let's say the market is having a super bull market, most people they don't care about diversification at all. Right? Am I right? Maybe you don't think about diversification is important if the general market is super bull. Why? It's like the air that you are currently breathing, right? The air that you are currently breathing through your nose. When there is air, you don't think that it is important at all. When you have lack of air, when there is no air, absence of air, only you would say that, oh, air is so important. We need oxygen to breathe. We need oxygen to live. So same thing back when we come back to diversification. The same example applies like the air that we breathe. When the market performs badly, when there is market shock or crisis, when there is a crash, then only most people realize that, oh, I should have diversified earlier. By that time would be very too late for you to do that, right? Because what has been done, what has been your portfolio may have get severely hurt or have a very big drawdown already. So by that time would be very, very too late. So it is important for you to understand diversification even before in any market scenario. So remember, you need to focus on the bigger picture. Remember, you need to look at the forest, not just only at the individual trees. You need to look at your overall portfolio as a whole. All right. So my point for you here is very simple. You don't wait until your portfolio suffer a big loss. Don't wait for a market crash already. Then only you think about diversification, because diversification and managing risk are supposed to be taken care of before things happen. Okay, diversification and managing risk are supposed to be taken care of before bad things happen. Don't wait until there is no air, only you think that air is important. All right. Now, earlier on, I mentioned about the word asset class, right? But I haven't clearly defined what asset class is. It might be a new term for you, but let me share with you this in simple terms. So when it comes to diversification, it is best for you to diversify across different asset classes. And what are asset classes? Very simple. Asset classes, we have different asset class. So the first form of asset class is cash. So this is where you earn your income, you make a living, so you have your savings all in cash form, right? And then the next thing is that when you have excess cash, what do? You may be, buying property, or you invest some of your cash into stocks, or maybe you put your cash into FD or even bonds. So this is where you are able, if you put all your money into a cash form, you might not be able to beat the inflation rate, correct? So this is why you want to invest your money to somewhere else, into stocks, bonds, or even maybe third thing, property, which is almost everybody have at least one property, right? And how else can you actually diversify your money into? Is actually you can diversify your money into commodities. So of course, earlier I've shared with you, you can invest indirectly into commodities or directly into commodities. So if you invest indirectly into commodities market, you are still actually considered as under stock category, okay? If you invest indirectly in commodities, you are still investing in stocks. But if you are able to invest directly in commodities, let's say FCPO, you are actually considered as commodity categories already. So this is where it is a separate asset class. So this is where you are able to get a better diversification benefits. And of course, there are some other asset classes where, generally people, those high net worth people, they will put their, they have hobby, for example, they might buying collectibles, buying antiques or limited stuff items to put, and then hoping that one day that, it becomes very precious. So these are other asset classes. So here, why do we need to put our money into different asset classes? Is because different asset classes, it has a different risk as well as a different return characteristics. It has a different volatility. For example, cash and bonds. Okay, no, stock and bonds. Stocks perform differently from bonds, right? So in theory, we would say that when stocks goes up, bonds may come down, or when stock market comes down, bond market will actually goes up. So this is why we would want to put our money into different asset classes. We want to put our money into different baskets, and of course, with different assets, they perform differently in a certain market environment as well. So earlier I've shared with you, for example, in a Super Bull stock market, right? In a Super Bull stock market goes up, but your bond market might be coming down a little bit, okay? So this is where if you have money in the bond markets, your bonds might be underperforming. However, when the stock market U-turns, or when stock market crash, stock market goes down, bond market actually goes up. Then how about commodities market? So commodities is actually a very special, unique class, because commodity actually is a form of raw materials. So regardless of how stock market goes, it actually does not affect commodity markets so much. So later on, I will give you an example for you to understand better why are they different. So here, back to this theory, let me share with you a quick one. What is diversification, why, and how you are able to do it? So the first thing, what is diversification? You can protect against downside risk. You can also reduce the downside impact. Now, what do I mean by that? By reducing downside impact. So let's say, example, let's say when the stock market crash, let's say Malaysia, FKLI is down by 20%. And if your portfolio is actually well diversified across different asset classes, if you were to put all your money into stocks, tentatively your stocks would be down by 20% following the market, right? However, if you were to spread out your money into different asset classes, maybe your portfolio is actually only down by 10% or even lesser than the market, right? Now, why is diversification important? So earlier I've told you that, diversification is like the air that we breathe. Most of the time, people would appreciate it when bad things actually happen. So let's say you are an investor or trader who would want to, if you were to diversify, you want to double your money in the same time of period, right? So there are two ways. So number one is that throughout the period, it is very volatile. And the second example is when still the same time, you double your money with the same time as well. Throughout the period, it is actually lower volatility and smoother and steadier, which has a slow growth. Which actually do you prefer? Let me repeat again, so that you have a clear understanding. You can actually reduce your portfolio risk and volatility. So let's say there is two trader or two investor. They want to double their money in the same time period. So let's say you want to double your money in the same 5 period time. Okay, there are two ways. One way is that you want throughout the same period, it is very, very volatile. And the second way, also the same period of investing and trading, but the volatility is actually very, very low. It is smooth and steady, and it has a stable growth in that. Which of these method do you prefer? Do you want to achieve, let's say do you want to double your money with a highly volatile market, or do you want to double your money with a low volatility, but it is a smooth and steady portfolio? Let me know your answer. Okay, number one, you want to double your money with where your portfolio is very volatile, or number two, you would want to double your money with a smooth and a steady manner. Okay, so both of them actually meet the same or achieve the same goal with the same way. They still achieve the same goal by doubling their money, but what they feel throughout the period, the stress level might be very, very differently. So some of you might be want smooth and steady, while some of you likes challenging and volatile. So it's fine regardless of this that you would choose, whether you want volatile, smooth, or steady. It doesn't really matter, because what matters is that whether does it good for towards your mental health or not, whether does it actually affect your trading psychology in order to achieve that particular trading goal. Okay, some of you want excitement, want volatility, whereas some of you would want a safe, slow and steady portfolio. It's fine. Now, how are you going to achieve that? So I'm going to share with you on this on the last topic. So to achieve diversification, you want to have assets or any positions that actually move different direction, or they don't move at the same degree. So later on, I give you examples so that you can understand this easier. Now, as I've mentioned already, stock market itself, it has limitations in diversification. So how do we able to solve this problem? So let me show you the limitations in stock market itself first. So let's say when the general stock market is up, okay, the first scenario, when the general stock market is actually up, some stocks don't follow the market at all. Okay, can you relate to this for those of you who have experience in the stock market? So let's say when FKLI or the FAMKLCI goes up by 200-300 points, some stocks that you invest or you trade just don't follow the market at all. Okay, so this is what we mean by low correlation. It don't follow the market. It doesn't follow the market at all. Whereas because some of the stocks are lagging behind the market. Okay, and next scenario is when the general stock market is actually down. So let's say Dow Jones Industrial Average is down by a lot, 10%. S&P 500 comes down by a lot. So this is where it also affects the general worldwide stock market, right? Now, most of the stocks will follow the general market direction comes down together one. It's very funny. And you see, market goes up, not all stocks follow together. But when market comes down, all stocks follow the general market to come down. Why? Because people are investors or those who hold stocks, they are fearful about the market. So this is where they want to convert their stocks back into cash. So this is why stock market, when general stock market is down, all stocks follow the general market direction. It's very, very highly correlated. And most stocks will be dragged down by the market because of fear. Okay, this theory has been studied widely across by researchers, and it is actually quite very valid. So some of you might experience this already, because sometimes market goes up, your stock might don't follow at all. But market comes down. Once market comes down, your stocks would generally follow the market already, right? Make sense? Now, by that, how can you actually further diversify your portfolio if you are just only investing in stocks or trading stocks, if all your money is just only in the stock market? Another one thing that you can do as a Malaysia investor or trader is that you just need to do one thing. You need to add different asset class into your portfolio. Asset class that has low correlation towards the stock market. And by that, I guess probably you already know the answer already, right? Now let's see by example, what do we mean by high correlation and low correlation? Let's go with the high correlation first. So here on this chart, we can see that on the top, this is FBMKLCI, where we represent it as a stock market. And another futures product that you trade is actually FKLI. So let's see their movement, whether is it high correlated or low correlated. So here we can see on this time frame, when stock market goes up, futures market follows the same as well. When stock market comes down, futures market, your FKLI comes down as well. And of course, FKLI, you can short it easily. But let's say if you still want to hold your stock, of course, you might lose some from the stock market, correct? Now, let's move on to the next time frame. Stock market goes sideways, your FKLI also goes sideways. You are unable to earn trade or profit from FKLI that easily. So we go to the next time frame. Stock market goes up, FKLI goes up. Stock market comes down, FKLI comes down. But here for FKLI, you can still short FKLI to protect your portfolio or make additional profit from here, and so forth and so on. Okay, so here we can see that. Can you see that both index FKLI index futures and the stock market actually goes the same direction? Can you see that or not? FKLI and FBMKLCI goes the same direction. So here we can see that index futures is actually still considered as very, very highly correlated towards the stock market. So here we do not have a diversification benefits, but you can actually protect your portfolio by hedging against your stock market. Okay, so later on, last chapter, I'm going to share with you how you can do that. So here, in simple terms, FKLI has a very high correlation with FBMKLCI. And the next thing we want to look at is on the FCPO, which is the Commodities Futures. So let's look at the same time period as well. So on top, we have already highlighted the uptrend, downtrend, and sideways for the stock market here. Okay, so now let's look at the FCPO. So here, FCPO first time period, there is up and down. We can trade both ways. Here sideways, if you were to invest, put FCPO in your, let's say you put FCPO in your portfolio, right? You don't make money. Here up and down, you may make some, maybe not. Here it becomes very, very obvious already. You see here, your stocks that you invest comes down, but your FCPO portfolio is actually going sideways. You don't make money and you don't lose money. Okay. Now next, here is the interesting thing. Stock market goes sideways for this particular same period, but your FCPO is actually having a general uptrend. So here, one segment of your portfolio is actually going upwards. You can trade having a long position here. Can you see that? And following the next period, stock market goes up. For this period, FCPO goes down. And the subsequent period, this one would be more interesting. Stock market, which is very recent, 2019, general stock market actually goes downwards, heading downtrend. But your FCPO is actually heading upwards, uptrend, downtrend, and then having a very significant uptrend. So here you can see that if you were to add this FCPO into your portfolio, so here you can see enough. We have green period and yellow period. Green period means you have good trading opportunities. Yellow means it's a sideways, you might not be able to profit from it. As compared to the stock market, which is the top here, we have several red periods here. Can you see that? So which is why all you need to do is actually add FCPO into your portfolio so that your overall portfolio can actually have a good and a greater diversification benefits. Because why? Regardless of how well you diversify in stocks, right? Once, let's say when there is market crash or when the general market is actually down, all of your stocks are actually affected. It has a very high correlation towards the stock market. However, FCPO, because it is a separate asset class, so it is not affected by the stock market at all. Okay, so in short, here, both stock market and FCPO, it has a low correlation. Whatever the stock market does, it will not affect FCPO over the long term. Now let's go on to the last topic here, the basic portfolio management strategy. I'm going to share with you some trading ideas here. So first thing on FKLI trading ideas is that, let's say when the market is up and you do not know which stock to choose. So this is where you can actually long index futures now. Remember FKLI, because why? You do not need to do any stock picking. You don't have to face which industry to choose from. You can totally eliminate stocks specific risk or even industry risk, which industry to pick from. You just need to long FKLI, that's it. Just follow the general market direction and you just only have market risk. However, if you were to just invest or trade stocks, you will face all of these risks. You need to do your stock picking, you have stock risk, you have industry risk, and you also can have market risk as well. In stock, you cannot eliminate all of these risks, okay? And what happens if market goes down? And I understand you might be, doing value investing or investing in undervalued or even growth stocks. You can use FKLI as well. Because you want to hold your stocks, right? And you strongly believe that the stocks that you're holding is undervalued or have high potential growth. It's okay. But when general stock market goes down, right, your stock portfolio comes down also, right? So how are you going to protect your stock portfolio value is that you can actually hedge against the downside by having a short index futures. You can short FKLI futures to protect your portfolio. And then when you think that the general stock market is already low, you can close off your short contract by covering a short or close your short contract when the market bottoms out. Okay, so this is where you just only do short position when the market is down, while at the same time you can also still hold on to your stocks. Okay, so this is one trading ideas for FKLI. And the next trading idea for FCPO is that you can actually add crude palm oil futures into your portfolio. So earlier on, I've already shared with you why FCPO is very, very unique. Number one, it is futures. You can trade both directions. Number two, you have leverage as well. And number three, it is actually different asset class from stocks. So now you can see that, let's take a very, very recent example. Our, FKL has been going down from, from the peak about 1,008 comes down to close to 1,005. But your FCPO is actually still heading towards an uptrend. And currently we are having a new high in FCPO market. So we can see that both stocks and commodity futures are actually a different class of product. The price movement for both, it won't affect each other. And this is where it would be good for you to directly investing or trading commodities by just adding FCPO into your portfolio. And because of that different price movement FCPO has low correlation towards the stock market. It doesn't care about whether stock market goes up or not. FCPO just go by its own way. So which makes it a very, very good vehicle, a good instrument for you to add into your portfolio. And of course, FCPO is different from stocks. It's different from investing in plantation companies. You don't have to look at management. You don't have to care about the earnings, whether the company has, a lot of borrowings, this and that, because you are directly investing in FCPO, in crude palm oil, directly towards the product. You don't have to worry about the stocks, all of these things. So you also don't have to worry about industry risk. As I mentioned already, FCPO is separate class. It does not concern about industry. It is a commodity product. So, okay, so far I believe you have already seen a lot of benefits why by just adding FCPO would be a very good idea for your trading. So again, let me share with you another round again. Here you can see that on top is your stock market performance. A green color means you are able to profit from the stock market by investing or trading stocks. Red color zone means that generally you have lesser trading opportunities in your stocks, or your stocks is actually underperforming. Yellow means it is actually going sideways. You may or may not profit from the market. You don't lose money from the stock market at all. Whereas for the FCPO, because it is a futures product, you can trade both up and down markets. So this is where you are able to benefit from it. Most of the time, you can see that it's either green or you don't benefit from FCPO. Okay. So depending on the strategy that you use in FCPO, if we have an opportunity some other time, I would share with you some of the strategies of how you can trade FCPO. Okay. So today I've shared with you some of the trading ideas and why by having FCPO by just adding FCPO into your portfolio, you can have a lot of diversification benefits. Okay, because FCPO and stock market, low correlation. Now, let me sum up for this is that 5 things that you need to know for today. Futures market is completely different from the stock market because the mechanism is very, very different. Commodity futures is different from index futures. FCPO and FKLI both are very different things. And if you want to do diversification, the best diversification is actually having low correlation assets or low correlation products. So which is why you do not want to continue keep diversified through stocks anymore. You can actually, by adding very, very low correlation product into your portfolio so that you can diversify even further into it. And number 4, index futures for FKLI, you can still trade it because you don't have to do any stock picking. You don't have to face all of those risks from the stock market. And lastly, FCPO is a commodities futures. It's a different asset class. It has a low correlation to the stock market, and it gives you a very, very great diversification benefits. All right. So today I've covered how you can enhance your overall portfolio return by diversifying your portfolio into low correlation products, which is the FCPO commodity futures. And I've also shown you several examples and evidence why by just adding FCPO into your portfolio, you can reduce your portfolio volatility and risk. Okay, so give a thought about it, and if you're still unsure or do not have sufficient knowledge about FCPO, so I encourage you to come back more on the LLF webinar or the LLF online workshop to learn more about the futures product. Okay, so that's it for today. And before I end, let me share you one thing is that a good trading psychology, it actually begins by having the right education and knowledge. Why? Because if the education that you get is wrong, or if you learn the wrong concept or wrong understanding about trading or investing, right, then when it comes to application, automatically you would apply it incorrectly, right? So this is where when you have wrong concept, wrong understanding, application will be wrong. So this is where it comes up with a lot of bad trading psychology that you do not want in trading that is very, very hard to solve. So always equip yourself with the right education and knowledge so that you are able to apply those knowledge with a correct application. So that's it. I would pass this back to Ting Ting.
Thanks a lot, CY. Now, let me share my slide first. Now, we are going to start with our Q&A session. Now, before we start, remember, just type in your question in the Q&A box and send it to all co-hosts. Now, before that, do you mind to just give us a 1 minute of your time, provide us with your feedback? That's the only thing that we requested from you. Just give us a very quick 1 minute. You can scan this QR code, or else in the chat box, there's a link. You can just use that particular link to provide us with your feedback. Just a very quick feedback, 1 minute. So we're going to start right now. I just repeat, you can scan this QR code to provide us with your feedback, or else in the chat box, you can click on the link. Meantime, while you are doing the feedback, you can also type in your question. We are going to answer all the questions in a short while. Okay, last 30 seconds. Once you already finished, you already submitted the feedback, you can start to type in your question. We try our best to pick up all the questions before the end of the session. Now, for those who still need to submit the feedback form, last 10 seconds for you to submit. Okay, time's up. If you yet to finish, it's okay. You can still continue to finish the feedback. Meanwhile, we will start to answer some of the questions being submitted. The rest, you can still continue to submit. Now, the first question, this is a very, very long question, and he's referring to a temporary market. Maybe I try to separate this question into two different areas, then we answer one by one, because in this particular question, we have 3 question marks. Now, start with the first section. Is there a possible chances for FKLI and the KLCI index to go opposite direction? As in the KLCI index goes out, but at the same time, some big players are short selling the FKLI futures. So maybe you start to answer this part, then later I will continue with the second part.
Yeah, it is possible on a very, very short-term basis, maybe a few days. Both FKLI and KLCI index may have a moving opposite direction, where there may be people hedging or shorting the FKLI index. So this is where this is actually on very, very short-term movement. So when we want to look at, correlation, we want to look at the general bigger time horizon to see what is the relationship. So on the short time, it may be moving differently. But if you stretch it out for a longer time horizon, it is actually quite highly correlated.
Yeah, if not, then arbitrage will come in, right?
That's right.
Now, the second part is, in that case, will FKI futures still going up following the underlying KLCI index, or goes down based on supply and demand of the FKI futures? So just to add on just now that question.
Whether FKLI futures would still going up following the KLCI index. It depends, because sometimes when for FKLI futures, sometimes it can be going leading the going ahead of the FBMKLCI or it may be lagging. So for whichever reason in that is that I don't know, because there will be there are different participants in the market, because this is where, you know, when there is a very negative correlation in the very short term, it means, you know, the stock market is actually going to what we call having a U-turn already. So this is where it depends on the liquidity, the buys and the sell side on the FKLI futures. So sometimes when there is a very low liquidity, but people wants to long or short FKLI, it may lead to the index futures to, you know, drastically moving up and down a lot. So this is actually goes back to actually, you know, the basic trading mechanism on the bid and ask.
Okay, the next question, very interesting question. Now, many of you definitely will have this question as well. So the question is, some people say that too much diversification is not really good. So in your opinion, which type of diversification is good and which type of diversification is bad? I think different school of thoughts.
Yeah. Okay, when it comes to the diversification, some, you know, there is one term I think Warren Buffett will use is diversification. The worse is actually WORSE, worse, making it even bad. So of course, when it comes to diversification, too diverse, you lack of concentration. So you might as well as, you know, invest in mutual funds or just buy up the whole market. So you do not have a benefit from that by having too diverse. It lacks of concentration. And by the way, we do not have so much energy and attention spent to look at everything in our, if too many stocks in or too many positions in our portfolio, right? So it would be good to have just good enough that we are able to monitor, good enough that, you know, whatever the market fluctuates, whichever products, how your portfolio fluctuates, you are still comfortable with it. Okay, the key point is you need to be comfortable with your portfolio fluctuation regardless of how the market does. Then I would believe that would be a good diversification already. Because some people, even although the portfolio is very well diversified, but because they just look at the trees only, they look at a very small portfolio, but not looking at the whole portfolio. So this is why even though they are very well diversified, they still are not quite happy with it, because they just focus on one or two single stocks only.
Okay, the next question, also another interesting question, is asking derivative, for example, FKLI and FCPO are high-risk asset classes. Is it suitable for diversification of portfolio?
Yes, a derivative itself, it's a high risk asset class. So because of the leverage, and in fact, yes, it is suitable for diversification. So which is why today I'm just only share with you the trading ideas, but not going too deep into the structure, the mechanism of how precisely we are going to do that. But of course, theoretically speaking, not just I say, this has been studied by researchers and those finance professors, where they sum up is that their summary is that when we are able to diversify into asset classes, any asset classes that has low correlation, it can actually brings down your overall portfolio risk and volatility very low. So of course, when we talk about volatility and risk, it deals with a lot with, you know, mathematics, right? So one of the factor that actually brings down the risk is actually low correlation. Okay, so low correlation is actually very important to bring down the portfolio risk.
Okay, so the key terms here, just to answer the question by Saifu. So it's definitely the correlation itself, because the correlation itself is going to bring down the overall risk of your whole portfolio.
One thing I want to add on is that, do you know hedge fund? Hedge funds, let's say those commodity trading advisors, where they just only having, which means they have zero stocks, where all of their positions are actually all futures contract. So this is where, because in United States, the futures, right, they have index futures, they have a well diverse of agricultural futures, commodity futures, energy futures. So this is where they themselves has, by through having a lot of very, very diverse products, right? So this is where hedge fund is, what we call a special category of investment, where they have an uncorrelated return, where, whatever the market does, it affects them very, very little. So this is where we can see that the low correlation actually gives a lot of diversification benefits.
Okay, the next question might be basic, but then maybe in one short sentence, can you please try to help to answer this question? What is the difference between FBM KLCI and FKLI?
Okay, FBM KLCI is actually the index futures that in Malaysia we use the top 30 market capitalization stocks to represent the health or the performance of the Malaysia stock market performance. Whereas for FKLI is actually a derivative product that actually tracks the performance of the FBM KLCI. It is actually it's like one is mother and one is son. So both are actually having a very high correlation, where the son has to follow the mother.
Okay. Now, this might not be really related, but maybe a quick question to ask. Why does bond price increase with decreasing interest rate and vice versa?
Why does bond price increase with decreasing interest rate? Okay. One thing about bond is that, when investing in bond, right, one of the factor that we look at is the coupon rate. So which means how much interest that you are going to receive from a bond, and that coupon rate, the fixed interest that the bond is going to pay you, is actually fixed, very confirmed fixed. And so there is a certainty of that fixed payment. So for example, your bond gives you a 5% coupon payment every year. Okay, 5% coupon payment, and regardless of whether market goes up or goes down, a bond is going to give you fixed 5%, and they won't increase. They would also not decrease the coupon payment, the interest payment. So when interest rate is going down, so let's say it goes down to lesser than 5%, would you want to put your money into some in the stock market that has less than 5%, or do you want to put your money into a bond that has, that confirms give you 5%? Generally, we will go for the higher interest rate instrument, right? Or the product that actually pays us with a certainty. So this is why when decreasing interest rate, so decreasing interest rate means generally when the market performance is going to give you the interest rate, but bond is going to give you high. So this is where people would want to switch their portfolio over to bond. They want to buy bonds. So this is what drive bond prices higher.
Okay, so this is some of our last question. There are still some of the question, but because of time limitation, so we are going to end the session. So before we end, for those who yet to submit your feedback form, please remember to submit your feedback form. Just provide us with the feedback. Then subsequently, as I mentioned to you, this is not the end of the year yet. So we have the whole lineup for the whole series of webinars until the end of this year, which is December. You did not hear you wrongly. So every Tuesday, technically, we are going to have these webinars from 8:30 until 10 o'clock for 3 different languages, from Malay, English, and Mandarin. You can select the session that you would like to attend, and you just scan the QR code and register accordingly. So you can also take a photo and share it with your friends. At least your friends will be benefited as well. So for those who want to register for the webinars or the online workshop, the link is in the chat box. Now, for those who do not have any idea about futures, this is the place that you can attend for the online workshop. So just now I can see that some of you might not really understand what is the difference between FBM KLCI and FKI. This might be the class for you because this online workshop is for those who seriously wanted to get started in futures trading. Through this class, we are going to cover for you from A until Z until you can start to trade your futures. So this is being sponsored by Bursa Malaysia and you don't need to pay anything. But the seat is limited. Every session, we only open up to 150 to register. And on the day itself, we only limited to first 50 online attendees because this session involves simulation, which we are going to answer all the session, and also we are going to guide you step by step through the whole trading simulation as well. So you can scan this QR code to register, or you can click on the link to register accordingly. Just for your information, 20th of November, only left a few seats. So if you really want to register for the English session, please register as soon as possible. If not, if you want to get it earlier, you can attend for Mandarin session as well. I think Mandarin session also limited seats as well, so please register as soon as possible. Now, this is the upcoming online workshop. So when you click on it, it will be October month. So what you need to do is you just need to click next for this November month. Now, before we end, just to introduce to you Bursa Academy. Bursa Academy is a one-stop e-learning platform. You can get all the information and knowledge via this Bursa Academy. So you can scan this QR code or else you can type in this website and to access to Bursa Academy. So this comes to the end of our session for today. Really thanks for your participation and make sure you stay safe and we are going to see you next week. Bye-bye.